there, good afternoon. This is BloombergQuint, and joining us live now is CBDT Chairman JB Mohapatra, straight from Delhi. Mr. Mohapatra, thank you for making time to speak with BloombergQuint. Through this conversation, Mr. Mohapatra, my aim will be to get clarity from you on the intent, implementation, and scope of some of the key tax provisions in Finance Bill 2022. And then I'll start with the one that that's caught public imagination the most in this budget, and that's the 30% tax on income from crypto assets. And stakeholders are a little unclear on some of the aspects here, which I'll sort of raise with you. First is, so I'll get straight to business. First is how to compute the cost of acquisition is one question that has been asked since day before yesterday. Will it include incidental charges like brokerage fees, exchange fees, gas charges, etc.? How do you view or interpret what's come out in the finance bill, sir?
Yeah, let me answer it this way. The surplus which is to be computed on a trade in virtual digital asset has been very briefly stated, the manner in which it will be computed in section 115 BBH. It says that the surplus will be carried out, will be worked out only by reducing one item, which is the cost of acquisition, right? And here cost of acquisition is a bare cost of acquisition at this point in time, right? Whether you can load anything more over the cost of acquisition, right? That is not provided, right? I will be trading cautiously on this area had I been an investor, not to load any amount other than the bare cost of acquisition.
All right. Okay. That's a very clear indication from you. The second area, sir, where clarity is required is the set-off provision. Now, it's clear that the set-off can't work inter-assets. So, for the benefit of our viewers, you can't set off crypto gains against, for instance, losses in mutual funds or shares. But what's not clear is, will the set-off work within the universe of VDAs or virtual digital assets? So by way of an illustration, can I set off loss on Bitcoin against gain in Bitcoin, or loss in Bitcoin against gain in NFTs, and assuming all of this is in the same financial year and nothing is being carried forward?
Okay, let me answer it in this manner. First, what is clear in the legislation is that loss emerging out of the chapter 12, that is the special provision in 115 BBH, it cannot be set off against any other head of income, meaning thereby it can't be set off against capital gains, can't be set off against house property income, can't be set off against income from business, can't be set off from income from other sources or salary or anything, right? That's very clear. All of the trading in the virtual asset, digital asset, are grouped together all in one through section 247 capital A, 115 BBH, they're grouped together, right? So if you make a particular stream of trading in a particular currency, then you have a profit, and in the other currency you have a loss. You want to set them both off, right? Under chapter 12. If you want a guidance on that one, clarity, guidance on that one, I can provide that. But what is clear at this, I'll provide that on a later date, right? Once we start, because this is an issue which has not emerged just from this discussion, but it is emerging since the day the legislation has been announced, right? I will not be erring. I will be erring if I preempt the answer and give something off the cuff right now, right? I am not going to commit on that, okay? But the point is well taken, that within that chapter 12 special provision in 115 BBH, if in one variety of currency you have a profit and in the other variety you have a loss, whether they can be set up, right? This is a very valid argument. I agree to the question which has been raised, but for an answer, give us a day or two in which we will come very clear on this one, right?
Okay, all right. So you eventually we can see some clarity coming out on it once we see the final shape given to this particular provision. The final sort of area that requires clarity on this section is the TDS provision. For instance, how will TDS work when you're executing trades on an exchange? Who will deduct TDS here? Because as I understand, not in all cases you know the buyer or the seller at the other end or the party at the other end, who will deposit this TDS with the government. Similar issues will occur if an Indian resident is executing the trade on an international exchange or a decentralized exchange. Could you throw some light on some of the the intent on the implementation of this TDS provision?
Correct. The larger intent would be how it will work out in the field. We'll have to wait. We'll hear all voices before we take a call. But the larger intent of the new provision 194S is to map the whole universe of the digital asset trade, virtual asset trade in the country, the investment and the trade. And this has been the traditional and the easiest way in which we can track the investments made, profits generated, or losses incurred in this kind of trading, right? So that's why 194S is being kicked in. And in the 194S, you have the liability to make TDS at the time of payment, right? Not at the time of receipt. So who will be making the payment? Payment will be made by the purchaser, right? Payment will be made by the purchasers. So onus is on him at the time of the purchase, as I understand at this point in time. And there are exclusions also in 194S, which will not require a TDS, right? In the case of specified persons, it is 50,000 in a year. If you do trading of 50,000 in a year, you escape, right? But you have to be a specified person. And specified person has been defined as an individual or a HUF who is not doing business in excess of 1 crore per annum in the one previous to the relevant assessment year. And in the case of professionals, you should not be doing professional receipt. You should not be getting professional receipts in excess of 50 lakhs, right? These two specified persons, classes of persons, they escape having the TDS obligations only if their turnover from the virtual trade is not in excess of 50,000. In the rest of the cases, it is 10,000, flat 10,000, right? Beyond 10,000 of crypto trade, they have to deduct the TDS under 194S, right? And 194S also will not apply for the specified persons alongside 203A and 206AB, meaning thereby they don't have to have a TAN, they don't have to have a TAN in order to remit that amount. And they also will not be saddled with that double taxation, double the rate of taxation under 206AB. So they escape that one. So TDS provisions may be read through a little more carefully, also by us also, and we'll hear all voices before we make up our mind as to how efficiently and how easily this can be worked out on the field.
Sure, but would you account for, when you frame guidelines on this, account for the commercial reality of how these trades work, that not in all cases, you would know the party at the other end? Would the final sort of framework account for this commercial reality, sir?
That's why income tax is getting into the whole, in the business of, the virtual asset class, because there's a lot of opacity. You don't know the counterparty, right? You don't. So that is why, to lift the the opacity and bring transparency to the whole the business which has been shrouded very maybe unjustifiably in rumors and all those things. So these provisions giving the taxing rights to the department to have this taxed not only will be beneficial for everybody in the market, including the exchanges also, but it also repose faith among the investors that their investment has been seen to be not contaminated or illicit, right? So department will ensure that whatever money is getting into the market is not illicit. It is not driven by it's not driven by what you call from unaccounted sources and all those things, right? And whatever profits you make, disclose a part of it to the government.
Yeah, I know, sir, the intent here, but I mean, stakeholders are concerned that some of these provisions might even kill the market making and the sort of trading capacity that we've seen in the last couple of years in India.
See, the fact that if you're hinting at the tax rate of 30%, and in some quarters they say it's
TDS, even the TDS provision, which some individuals who have crossed the prescribed threshold, might find it onerous, given they might not know against whose PAN you are actually deducting the TDS.
I know that there will be teething problems, but the point is, if you make investment either directly or through P2P, right, through the exchange or in P2P situations, right? If you're doing it through the exchange, there's no problem. You should be knowing the exchange, right? When it comes to P2P, which is also a sizable sector, so we'll be doing P2P. It's essential that you know the counterparty, right? If it is routed through the exchange, there is every reason as to why you would not be knowing the counterparty who has placed the purchase order against your sell orders. That will not be knowing, and justifiably so. But in a P2P situations, if you are knowing the counterparty, right, then there is a problem. Can't let the opacity hang around this business for a long time.
When it happens through exchanges, let's say domestic Indian exchanges, will it be the onus be on the exchange to deposit this TDS?
At the time of payment, it is stated. So can't hear.
I'll repeat myself, sir. Am I audible now?
Yeah.
My question is that in the case of exchanges, Indian exchanges, will the onus of deducting and paying this TDS be on the exchanges from April 1st?
See, I am told, and this has been reported, that exchanges in crypto work in a manner which is different from the normal stock exchanges, right? Here, the exchanges, they create the market. They are the market. They are also market participants also, right? They take positions counter to the investor in many cases, or in most of the cases, in some exchanges, right? A purchase order of a customer may be directly dealt with by the exchange itself, right? Through its own stock. So these are situations. Point is, if that is happening, then whoever is to pay will have to deduct that 1%. If the exchange bears that responsibility, then it has to deduct the tax, right? TDS. So the point, what I'm trying to convey to you, that 194C situation should be applying, the provisions should be applying in all cases of transaction, whether you are doing P2P or through the exchange.
Okay, I understand, and you also acknowledged that there will be operational difficulties in implementing this, and we do hope that the final shape of this provision is clearer on all these aspects. I'll move on to the second area that has sort of created some turbulence among stakeholders, and that's got to do with Section 68 that provides for tax on unexplained cash credits. Essentially, now the amendment puts the onus on borrowers to ask lenders for their source of funds. What has prompted this move, Mr. Mohapatra?
Yeah, that this is a significant amendment, right? This, but we want to be very clear on what we are intending to do with this one, sure, right? Like in Section 68, if there is a credit, that is, there is a loan or a borrowing or a receipt or an amount against somebody else, in the name of somebody else in your books, that means you have received the amount from him, whether by way of loan or borrowing or normal receipt, right? The taxpayer has to explain that where the money is coming from, right? Where the money is coming from. He has to identify, right? Now, in the case of the private companies, what we have done, that the verification of the person is whose name the credit stands. For the private companies, we were going up Now we were looking at the share capital, share application money, and share premium, right?
Right.
On a source to source verification, right? Source to source of source verification, right? We can go one step forward, right? It was only limited to that part, source of source verification. Now the source of source verification, right? Inquiry, we have extended it to loans and borrowings, right?
Yeah.
The point is that has been probably, it will not be stated in so many words, but in whispers it has been stated, and it has been confirmed in many of our investigations. Life is difficult for an investigator in the income tax department or for any other agencies, precisely because whole set of entry providers operating in gray, in what you call, in not in dark areas of the economy, they are intent on introducing illicit cash and unaccounted investment through layering of various accounts, right? Entry of cash from at one end, and through layering of 14, 15, 17 bank accounts appearing as a cash credit in the 15th account, right? It's a very onerous task of going to the real source of the deposits, right? Real source of that deposit in somebody's account, right? If the loan or the borrowing is untainted, it is coming from the right source, right? And from a man, not a straw man, but man with credibility and creditworthiness, identifiable. There's no problem, no worries for those kind of investment. But if the aim is to rotate the unaccounted money through layering, Section 68, the new provisions should be coming hard on that.
Sure. I do want to understand from you how practically it will work, sir. What are borrowers expected to do now? For instance, every time a startup raises capital, what documents or evidence is it expected to ask from the lender to be able to then, tell you, the department, a year or 2 years or 3 years down the line, that look, this was from a genuine creditor, there was credit worthiness, etc. So what is the diligence that I need to do today?
No, see, Section 68 specifically in the proviso or in the explanation, it excludes some defined categories in which you cannot, investigate any further, right? That promise remains. This Section 68 is never meant to be targeting a particular sector, right? It cuts across sectors, across all statuses, right? So there is nothing to fear. The point is, Section 68 is not redrawing the provisions of verification of the cash credit in any manner, right? But it wants to stop the layering exercise, which has gone on unabated for a long time, and we want to come hard at this racket.
Sure, I get your point, sir, that it's an anti-abuse provision, but the fear stems from the indiscriminate use that we've seen, coming out before courts. For instance, where documentary evidence shows genuineness and creditworthiness of the borrower, proceedings have been initiated and courts have set those aside. That's where the real fear is stemming from.
No, see, at the end of the day, statistically, you can prove me right. Statistically, I can prove you right also from the other side, right? Anecdotally, we could be both right in our own versions, right? One exception to me may be a rule to you. So let's be clear that this has been brought about after a lot of thought, after years of doing research in this area, right? And how it is implemented, how smoothly it is implemented, is an area which will work very closely, right? Section 68 is one part of the whole fabric of the department, right? And it is not even, it has been an oft-used provision in some earlier times. But at this point in time, if you look at the kind of additions being made in assessment orders, right? Section 68 will not be there up there, right? Section 68 has been very sparingly used in recent times. You can have a study on that one, but from my gut would say that this is what is happening in the field. Section 68 has been used sparingly, but in real good cases, right? Anecdotal evidences would say that, the courts could have thrown many cases away because of, proper lack of verification or something. But use of Section 68 also has come down quite a bit.
Okay, so implementation wise in day-to-day transactions, what has changed? Could you sort of put that in perspective for us?
No, nothing has changed. Nothing has changed on the field. And
so what I meant to ask is, when I'm raising capital as an entity, share placement on a private placement basis, what is it that has changed for the assessees or the borrower after this amendment?
No, that nothing which has changed. Point is, if the pool of money which is coming from some source is untainted, it is coming from genuine sources, right?
So to ascertain that genuineness, I need to do some exercise today, right? Maybe ask questions that I wasn't asking so far.
See, at the end of the day, just the PAN or the bank account do not suffice about the regular nature of the remittances being made. Take it from me, the PAN number or the balances in the bank account don't really conclusively prove that the remittance is from the right regular sources, right? I don't want the taxpayers to get into second and third degree of investigation to find out. They would rather be busy in the business rather than looking at the bona fide of the the money coming in, right? But due diligence, in whatever way you can, to cut out that there is an angle of illicit nature in the funds which you are receiving, that would help. And the telltale signs surrounding that investment, surrounding the money which is coming in, from your gut feel or your workaday experience, a taxpayer would very well realize where the money is coming from and whether it is coming from right sources or from sources which are not to be relied on.
Okay, all right. I will not sort of delve further into this because, once this provision is rolled out April 1st onwards, we'll know, how the implementation is working. The only hope is that, the department lives up to its promise that the use will not be indiscriminate and not irrational. And there will be a guidance that will go out to field officers to use it in very genuine cases.
Absolutely. Agree.
Okay. The third area, sir, that I'd like to sort of get your thoughts on is the 10% TDS and perquisites. Now, those were always within the tax net. I think, now the onus has shifted from the recipient to the sort of payer or the business. Is it a revenue mobilization move in any sense, or this is an enforcement fix because recipients were not paying tax on perquisites?
No, this, that 10% reduction that was under 194J, right? 194J on consultancy, on professional services, 10% was there, right? What is being brought in is TDS on benefits and perquisites.
Yes. Provided
by businesses. But what is not written is that, these are payments in consequence to business promotion of businesses, right? A wholesale dealer taking the retailers on a business promotion, tour to Singapore, right? Or giving them, discount coupons to spend at the retail shops of their choice of a particular amount, if you achieve this target and that target and all those things, right? So the business promotion related expenses should be coming over here, right? Many of these payments, cash or kind, mostly in kind, they're not being captured in the system, right? But this is a benefit or a perquisite as understood in Section 28 also, right?
Correct. Yes.
We are now realizing that this is an area which needs to be tracked, right? So therefore, 194R has come in here. 194R has come in. It says that if it is more than 20,000 in a year, the payer has to deduct 10%, right? before doing this kind of after he incurs those expenses. So this is just to have a clear overview of the business promotion expenses and how much is being laid out in a year by businesses.
I know probably the answer to this, but the memorandum to the finance bill, Mr. Mohapatra, refers or makes references specifically to the pharma sector, but of course the charging section makes no such mention. So this is sort of applicable on all sort of perquisites across sectors, across businesses.
Absolutely.
Yes. Okay. There are also some specific doubts that have been raised with the valuation of the benefit of perquisite, and I'll use an illustration a consulting firm sort of shared with us. Let's say in a debt restructuring scenario, there would be write back of loans that has been seen as a benefit of perquisite and has been contended so in the past. Should lenders be deducting 10% in such situations? Is that the intent of the provision?
I and we never thought about this one. So you're giving us ideas, but let me. I would not say whether it is intended or unintended, but this is I don't know how to classify this particular question, but your point is noted. I have noted your point.
Okay, all right. I do hope, sir, that in the final sort of version, we do see some sort of, clarity on this, either by way of guidelines or, the best possible way to communicate to the industry to be able to know the real intent and not have unintended consequence of this 10% TDS. The final sort of, umbrella of change that I want to talk about is the reassessments. And that's got to do with income that's escaped assessment. There's a view, sir, that this year the government undone the reformatory approach that we saw in last year's financial act. The scope of what constitutes as information which will become the basis of reassessment, that has been expanded. The time limit for issuing a reassessment notice will also now cover cases where there is expenditure in respect of a transaction or in relation to an event or occasion. Hasn't this considerably watered down the relief that we saw last year?
Absolutely not. I beg to disagree on all the points which you have made, right? There have been 3 significant amendments over here, right? In section 148, section 148 capital A. Then there is an insertion of a new section 148B, I think, 148B, and there is little amendment in 149, right? 148 originally said that any information which is coming through the risk management strategy of the department, number 1, and number 2, the final objection of the CA and AG, right? These are the 2 areas, right? Now we have expanded. In what way? We have said that information from RMS, that is there, information from C and AG, right? That we have said. Our own internal audit also is there, right? We have said of any audit objections should suffice for reopening, right? Then in 148A, what we have done, there is 148A is the process through which the reassessment is done, right? These are procedural sections, right? We have streamlined it. There are some 6 or 7 approvals, 4 approvals required while triggering this 148A, right? But now we have reduced it to two levels, right? 4 situations will be there. Information, AO will putting the information to the taxpayer, saying that this is the issue, I want to reopen. The taxpayer answers. The AO considers. Then he finally gives a verdict whether it is good to go for reassessment or not. There's a post. We have streamlined those sections. And in section 149, very critical, right? Initially, what was stated that if the undisclosed part or undeclared part, which should be an asset, okay? Asset is defined also in 149, saying that asset, land and building, right? Bank balances, right? Loans and borrowings, loans and deposits, right? Of a value of 50 lakhs, a loan should constitute, right? It should be, you should have information, and you should have you should have what you call this kind of asset that will qualify. So what I'm saying is that these have been also, we have put in little things like expenditure in relation to, or a transaction in relation to an expenditure or an occasion or an event, right? Unaccounted expenditure, suppose you get the details of those unaccounted expenditure, right? And entries in the books of accounts. These are 2 or 3 little things which we have done. We have not undone anything which was done in the last budget, right? What we have done, we have made it more practical and be realistic about things which are happening on the field, right? Suppose you have documented, the counterparty has stated that yes, this building was, or rather, this jewelry has been purchased by Mr. So-and-so, and I have received 50 lakh in cash, right? Unexplained expenditure, right? The old legislation would not have captured, although it is admitted position of just not the jeweler, but by everybody else, that yes, 50 lakh of jewelry has been made for this person. It has been delivered and everything. So in those situations, unexplained expenditure was not being captured, right? Entries in the books of accounts were not being captured. Entries in the books of accounts, there will be some entries in your names, cash purchase, cash sales, or cash receipt and cash outgo. Everything will be there, but it could not have been captured. Although these are confirmed, not just by the creator of those books of accounts, but by the counterparty also, right? Everybody says that yes, these cash entries, these entries are the reflection of the original business, right? But still then we are not capturing. What has been done is not watering down the old 148, 147, and 148A and 149, but trying to smoothen the rough edges. Let me assure you, the old provisions, they stand as they are. We have not expanded one bit.
Right, and of course, the litigation apart that we are seeing in high courts. Mr. Mohapatra, your team tells me that you have another appointment to keep, so I'll let you go. Many thanks for joining us here on BloombergQuint and very patiently answering some of our questions. Thank you for your time.
Thank you. Thanks.